Hey everybody, great to be with you again. It's been a little bit since we've done a market update. We are going to a video format and excited to see how that rolls out looking ahead. I think it's going to be really great for all of you guys. So we're going to dive into what's going on in our market in this third quarter of 2018. And for the most part, it's actually been tracking along in similar fashion as I've maybe either predicted or shared with some of you in the past. Which is in essence, we are in an environment market-wise where our supply is pretty low at 3 months market-wide. However, we're not getting appreciation that you would normally see at that low a supply point. Normally at 3% supply numbers, or what I would call months of inventory, you would see 7 to 10% appreciation in a local real estate market, and we're not actually seeing that this year. Actually what's happening is, actually before I go into that, what I'd like to maybe define a little bit for some of you that may not be familiar with the term supply or months of inventory, is a 3-month supply is basically a measure of how much inventory there is based on a certain rate of demand in the marketplace. So for example, if we have 3,000 homes on the market for sale today, and over the last 12 months, 1,000 homes a month are selling, then how long will it take to sell all the inventory? So 3,000 divided by 1,000 is a 3-month supply. And so again, 3 months is considered pretty undersupplied. To give that more context, a 6-month supply anywhere in any real estate market is typically considered to be a balanced or equilibrium market, where buyer and seller demand are meeting in the middle, and usually you're going to see a 4 to 6% appreciation rate. So why are we seeing maybe only 5% to 6% appreciation when we have 3-month supply? So there's a few things going on here. Number one, the price bands are acting extremely differently. For example, between 0 to 500, we are very low supply at 2 months, and we're seeing 6-7% appreciation. But then as you go between 500 to $1 million, the supply number is closer to 5 months, more of a balanced market, and appreciation's been pretty flat, maybe 1 to 2% at best this year so far. And then once you get into the $1 million price band to maybe about 3 million, we're seeing actually an oversupply. It's at 10 months, so well over the 6-month range. And there you're actually seeing prices come down 3 to 5%. Once you get to above 3 million, that's another different tier where you're actually, if you're new construction, you're very undersupplied. If you're resale, you're seeing about the same thing that's going on in the $1 to $3 million range, where it's about a 10-month supply. So when you add all that up and you average it, it's leading to about a 3-month supply market-wide, but yet only about a 5 to 6% appreciation, because there's some price bands that actually aren't doing so well on the appreciation side this year. What's maybe causing some of this? There's several factors actually. One is that the employment here, which is our primary driver in our market besides lifestyle demand, employment is still very strong. We're at about 3.5% employment growth, which means about 30,000 jobs a year. And while that's good for number 2 in the country, actually, it also isn't as strong as it's been over the last several other years. From 2011 to 2016, we were seeing 35,000, 40,000 jobs. So that was creating an even bigger push, especially in the higher end price bands. In addition to that, there's interest rates. Interest rates start moving up, and that impacts our market also, and that slows things down a little bit. And then finally, affordability, where it is costing so much to build right now, and prices have moved up since 2011 about 50%. But in that same time, average household income has only moved up about 10 to 12%. It's too big of a delta, and it's actually even impacting high-earning households from not being able to afford homes. People are waiting longer for that. And so, especially in the higher end, that's why you're seeing some of those supplies being oversupplied. So that's kind of in context, or if you accumulate all that, that's what's going on in our market and why we're seeing, again, some lower appreciation rates. I expect this kind of environment to continue through this year. It was the same last year. And I think around mid-2019, this will all start shifting because our employment growth, I think, will start kicking back up into an even stronger range than it already is. People will start getting used to the interest rates having moved up a little bit. And then also the average household income now has had a few years to move up some, while prices, especially in those higher end price bands, have come down maybe 10%. And so there's more of a balance factor there. Finally, construction costs are also expected, with the new tariffs, are expected to actually move up construction costs again to the tune of about 10 to 15%. That's going to naturally put some pressure in housing prices as we go into next year or the middle of next year. So I hope all this made sense and hope this was informative. Go to our website, www.tarekmorshed.com. So you can get the full download on this, as well as supporting articles and of course all kinds of other information we have on the website. And of course, reach out to us at any time. We can talk about your specific sector and what's going on. And we look forward to speaking. Take care.